Throughout 2022 so far, the stock market has been absolutely hammered. I'm sure you're not going to be surprised to hear that. Now, crypto and other massively speculative assets have also been getting hammered too, and this is all basically because of an overheated economy leading to massive inflation everywhere, and then what that has led certain central banks and other institutions to do. This has been now a long time coming. Back all the way during 2021, myself and many others out there were telling you that it's coming, and it's finally actually here. A more recent narrative that's been going around though is that actually the bad times are over. We've reached the bottom and we've rebounded over the last month or so, and that we're in store for a mega rally and that nothing but bullishness is here for the future. The last month was obviously very strong for the stock market. The S&P 500 was up by around about 9% for the month, which is monumental. So is that rally here to stay? Well, Michael Burry says not, and he personally thinks that things are going to get far, far worse from here on out. This video will of course explain everything that he's said over recent weeks and months, why he thinks the things that he does, and why it's actually really important that we pay attention to what he's saying. Really quickly though, before we get into that, I want to give a quick shout out here to the Daily Upside and thank them for partnering with us on this video, but more on that later on in the video. So who actually is Michael Burry? Well, you probably know him from The Big Short, as most people do. It's a really popular, actually really interesting film looking at the 2008 global financial crisis and how he personally predicted it and made himself hundreds of millions of dollars off of that prediction. He's actually become a little bit infamous over recent decades for calling out bubbles and market crashes, and he also did the same thing with the dot-com bubble, and he's saying the exact same thing here today. He has made himself hundreds of millions and his investors too throughout his funds Scion Asset Management and Scion Capital, but some like to say he's a broken clock and that he's only ever right about these things every now and then, and more often than not he's actually wrong. Now this can be refuted by the simple fact of looking at his investment record. His first active fund ran for about a decade throughout the noughties, and he made himself and his investors over 500% in returns over that decade. During that exact same period, the S&P 500 made its investors just 3% over that decade. Now since COVID came and disrupted everyone's lives and the government decided to take a really rather radical route towards solving the problem that COVID created, well, stimulus and money printing became widespread all over the world, and Burry saw exactly what was going on, and he started to prepare for the next massive market crash, and come 2022, it's here, and it appears he was right once again. Now this started off actually over a year ago from today, with Burry first predicting massive levels of inflation long before it actually arrived. Now this tweet here is from February of 2021, and he had this to say: "Throughout these years, the structure was quietly building itself up for the blow. Germany's inflation cycle ran not for a year, but for 9 years, representing 8 years of gestation and only 1 year of collapse." Written in 1974 regarding 1914 to 1923. He then relates that to current years, 2010 to 2021, as gestation. Basically, he's likening the previous decade or so of quantitative easing and gross money printing by our governments to those actions of the Weimar German government that led to hyperinflation back in the early 20th century. It's also worth noting that actually Burry's inflation thesis surrounds pretty much everything else that he does with his investments, and that's exactly how it has been over the last few years since the government really went completely off the rails and started throwing money out of helicopters onto its citizens, sending out stimulus checks and spending and printing as much as physically possible. Now before we get on with the rest and the meat of this video, I'd like to quickly tell you about this video's sponsor, the Daily Upside. Now, if you're like me, you find yourself sifting through loads of different news sources trying to find yourself unbiased and insightful pieces, then the Daily Upside is here to fix your problem. It's an absolutely free daily financial newsletter written by a team of financial experts with loads of real-world experience, and it's currently read by over 500,000 investors every single day. For me, it's become the first thing that I read every day when I wake up because it's informative, entertaining, and it's still not dumbed down. They give you the most important news with real analysis and often go in depth on some specific industries or developments, giving you knowledge that most people just never learn. Just last week, they put out this great piece looking into the details surrounding China, its looming banking crisis, and the capital flight that it's currently experiencing. Whether you're a financial professional, a retail investor, or just looking for a great source of unbiased news, then the Daily Upside could seriously help you stay up to date quickly and easily. It's absolutely free to sign up, and they send you just one information-filled email every morning. I personally can't recommend it enough, So if you want to be better educated about the markets tomorrow, then sign up using the link in the description down below today. Where are we with Michael Burry today then? Well, I'll let him tell you himself. Adjusted for inflation, 2022 first half S&P 500 is down by 25 to 26%, and the Nasdaq is down by 34 to 35%. Bitcoin is down 64 to 65%. That was multiple compression. Next up is the earnings compression, so maybe halfway there. Now, halfway is a scary idea for sure, but Burry does have a point here. Back in the global financial crisis in 2007, financial markets were falling apart, but banks and companies were actually still posting pretty strong results. Earnings were quite strong and companies were still making decent amounts of money. So many people thought, how could it possibly get worse than this? No one is going to sell JP Morgan shares at a 10 PE ratio. It's just too good of a deal was the basic idea. That was actually the multiple compression in action, companies simply being valued cheaper. They saw PE ratios of 10 instead of 20, and they saw PS ratios of 2 instead of 4. We had better deals for investors, better forward earnings, better DCF valuations. The problem was, though, investors ignored the fact that that was only half the problem, and that multiple compression was actually a rather tame phenomenon. Earnings compression is the real problem here. Companies find themselves making less money simply because their customers are now poorer than they used to be. People have lost their jobs, they've been forced to take pay cuts, they stop eating out at local businesses, and those local businesses suffer. So they go out and lay off a bunch of staff who now also can't afford their usual things, and public companies eventually start to get impacted by this exact same effect. They see their revenues start to fall slightly, and then all of a sudden it happens very dramatically. Now, they've already seen their PE ratios drop from 25 to 15, so investors now think that they're a good deal and they jump into those investments. But now their earnings drop by 50% as well, so the share price halves once more. This happened during the global financial crisis in 07, in 08, and in 09 as well. The market crash actually took about 2 years to play out, something that so many people are conveniently forgetting today right now. Stocks were already down by 20 or 30% Stocks were already down by 20 to 30% on average, and then in 2009, in the early months of the year, they crashed another 30% across the board. That was earnings compression, and we've yet to see it here during this cycle, but it almost definitely is coming, and it's one of the biggest issues that Burry is telling us to look out for. Just a few days ago, he tweeted out this: "These earnings reports, and by Jove, the whole season, have a last hurrah feeling." We are now in earnings season, and some companies have been posting actually really strong quarterly results over the last 3 months. Some, on the other hand, have been posting quite poor results, but by and large, Burry thinks that this is the end of that bullishness. This is the last quarterly earnings season that will actually be good, and that in 3 months' time, it will be a very different story. Revenues and sales figures will drop across the board, and as a result of that, stock prices will tank as well. Now, just why is Burry so sure that this earnings compression is coming though? Well, simply because a recession is here and there is no way around it at this point. GDP data has already come out for the first half of this year for the United States, and as we all know, 2 consecutive quarters of negative GDP growth is by definition a recession, and we can ignore anything that the White House or Biden tells us when they try to gaslight us into thinking otherwise. Consumer confidence is also at rock bottom levels right now, and when this happens, one other thing happens as a result of it. People get worried. They stop spending the money that they do have. They start to save their money because they aren't sure where the economy is going to go. Local businesses suffer, they lay people off, and this effect creates a recession itself, and that is exactly what's happening right now. Inflation is still sky high too. Now, we were told time after time after time that we would first never see inflation at all, and then once it came, we were told it would be a momentary blip, and then we were told that it was transitory, and then finally we've been told that it's peaking every month for the last 6 months. Every single time these pundits have come out with these predictions though, they've been wrong. The uncomfortable reality is that it's likely they're wrong here again. As inflation stays high then, the Federal Reserve will have to keep hiking interest rates, and higher rates means more expensive car loans. It means your credit card debt gets more expensive and your mortgage gets more expensive too. At the end of every month, there will be less money in your pocket, which means less spending on consumer products and a weaker economy. Higher rates also means expensive bonds and loans for businesses too, and so they find themselves investing into the future at a lower rate. This again impacts growth and it weakens the economy. The war in China is not stopping anytime either, and relations with Russia are deteriorating by the day, meaning that global commodity supplies are always a little bit uneasy. To make matters even worse, relationships with China and East and West in general are really poor. We're at each other's throats, and there will be no change in that arena either. There is no way out here. We are past the point of no return. The crash is here. The recession is here. It's been here for 6 months now, and it's not over yet. Now, hearing that, I know a lot of you would just like to know, what is a sign of the bottom? How do we know when it's safe to start investing in markets back again? And in my opinion, it isn't about euphoria or fear or greed, as so many people would have you know. Warren Buffett's famous mantra of buy when there's fear but sell when there's greed doesn't really apply to the greatest speculative bubble of all time, because different things are in effect here. Burry has his own views on this as well. I don't think this is going to be over until everybody swears they will never own an NFT, they will never own crypto, and they will never own a technology stock. Such was the sign in 2002, 1932, and 1974. 2009 was a panic bottom, but 07 not a speculative peak in stocks. This time round, the bottom will be characterized by apathy. You will no longer care about stocks, crypto, investing, or your pension or anything like that. You would have been bleeding money for years at that point, and you will have simply just given up with investing. My YouTube channel right here will have a fraction of the audience because no one will care about it anymore either. You will not read about the markets and their daily moves on CNN or Fox News, and you'll stop checking Bloomberg and CNBC too. It will be utter total apathy, and that will be the bottom of the market. Because this was a speculative bubble based purely on euphoria and getting rich quick, with quantitative easing and 0% interest rates fueling the actual fire. 90% of the people watching this video today will miss this bottom, purely because you'll move on and do something else with your life. Now, I'm personally determined not to let that happen to me. I will pay attention no matter how boring this market cycle gets. No matter how much money I lose in the markets, no matter how much stocks bleed, no matter how few of you watch these videos, I will keep putting this content out. And if you want to do the same, if you also want to make this next cycle work for you and make your millions, all you really have to do is to keep watching, to pay attention to what's happening, and of course to subscribe. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.